We're standing by for interest rate announcements from both the Bank of Canada and the Fed today. Let's get a bit of a historical perspective here from Keith Richards of ValueTrend. Keith, always great to talk to you, and thanks very much indeed for joining us.
Yeah, hey, Andy. I'm not in the studio now. This is welcome to my office. I'm always seeing you in the studio.
We miss you. I'm disappointed there's not a bicycle hanging on the wall, one of your carbon
there is,
fibers.
but look at all the bike stuff in the back.
Oh, okay. You looking back over history, I guess it's not a tremendous revelation, but when the Fed is dovish, it is good for the markets.
Yeah, I mean, we've got Bank of Canada and Fed today all talking rates, I guess. Yeah, I actually I posted a chart on a blog just recently, but I've been posting this chart on my blogs for years, showing that whenever the Fed tightens, you're almost guaranteed to move to the downside. It's kind of a leading indicator, and whenever the Fed is in a stimulation mode, whether it's rates themselves or quant easing or the twists they did a couple of years ago, they were manipulating bond durations. Whatever the case, the market basically is always favorable. As the saying goes, you don't fight the Fed. So I think that's kind of the mode you got to be in right now.
But maybe we'll put up a 10-year chart here. But when the Fed, for example, warns of fewer reductions ahead, that tends to give investors cold feet.
Yeah. In fact, again, I would maybe encourage. I was trying to send you guys my chart, but I was told it was a bit too convoluted with all my little arrows and stuff, because I noted every single event that the Fed has induced. But basically, I have a blog called The Conundrum, posted a couple of days ago, and at the bottom you'll see that chart. Mm-hmm. And basically, if the market is very, very sensitive to any sign of even a hint of slowing on the monetary easing. So at this point, though, that's not the case. In fact, in the U.S., we've got what's his name, Kevin Hassett. Mm-hmm. Yeah, that's right. I had to write it down. Who's probably going to take the role in the new year. So that's all bullish for the market as far as I'm concerned.
Of course, these things get discounted in advance by investors. Absolutely. What is it? John Maynard Keynes says it's not a beauty contest, really. It's everybody's trying to decide what stocks everybody else will think are beautiful, and it turns into infinite hall of mirrors. But tell us, isn't it like, or is there a chance that today the Fed will issue some kind of cautionary note, given what we're hearing about division? Some people want to stand pat now on rates.
You know what? That's as you know, Andy, I'm a chart follower, and so I'm not going to make any commentary on that. But what I will say is that, to your point, sometimes news is baked in, and you can even get what they call sell in the news, and that happens with stocks, companies all the time, right? So you're expecting an earnings report, it comes out as anticipated, and the stock falls because there's a lead up. And that's the same with the market. So there's always a potential that, because everybody's expecting the Bank of Canada to stay pat, and everybody expects the Fed to ease 25 basis points, we may actually have a negative reaction. I don't think it's going to be long lasting, though, because it depends like you say, if they give hints that it's going to slow, the easing is going to slow off, then sure, that could cause some duress on the markets, but I won't guess.
The Bank of Canada, maybe we'll put up a 10-year chart for the TSX here. The Bank of Canada, of course, has led the Fed. It's been much in advance of cutting interest rates. And it looks, they did warn us at the time of the last announcement that they're pretty well done for now with reductions. Yeah,
McCallum has been very straightforward with that. And, we needed it. And so it's definitely... Actually, at the beginning of the year, on your show, as well as through my blogs and my videos, I was suggesting way back in January that the TSX would outperform the S&P 500. I remember at the time when I was saying that, I got pushback, but it wasn't just because of what the Bank of Canada was doing, but the commodities which have done very, very well, as we all know. So, I mean, I think that this is kind of expected. You may get, already we're starting to see both on the S&P 500 and the TSX 300, there's been a little bit of consolidation. If you kind of look at the way the pattern has been over the past few weeks, we could see a bit more of that. But, Santa rally's coming, right? That's the last week of the year into the first couple of days of January. And you'll probably get that usual pop. I think it's an average of 1.5% historically over the past 70 years. You get an average return of 1.5 or so in that week. That's just an average. But I think whatever noise we see in the short term, you'll see that pop. And it's into the new year as to the question I have regarding what the market's going to do, because things are overbought. The TSX is like 14% over its 200-day moving average right now, which is pretty high, and the S&P is like 10 or 11%. So it is still a little overbought. But the TSX needs some pullback.
Sorry to cut you off, Keith. Thank you very much indeed, Keith Richards.